Welcome to Chat with Nat, the podcast where real conversations meet real life. I'm your host, Natalie Keim, an entrepreneur, financial professional, caregiver, and an advocate for living fully. This show dives into the stories and strategies that shape who we are and how we thrive. I want to start this episode with a question. If something happened to you tomorrow, would your family be okay financially? Or would they be scrambling to cover funeral costs, mortgage payments, and everyday expenses? I recently shared on my social media a reel that talks about the fact that my parents don't have life insurance for themselves, and they can't get it. Why? Because nobody knocked on my parents' door to provide a financial education, to talk to them about life insurance and all the benefits it could provide, the different types of life insurance that would be available for them when they were younger. And so they never got it. I stepped into this industry 6.5 years ago and learned all the things I know today. But by that time, my dad was a 2-time cancer survivor, a heart attack survivor, and my mom had been diagnosed with dementia. All of those things are disqualifying factors when it comes to getting life insurance and especially living benefits. Now, my parents saved well. We have great plans in place for them as far as where we put their money to make sure that we can provide for all their needs in the future. And I'll dive into the details of all that, I'm sure, in a future episode. I have in the past talked about it a lot on my social media and even in my previous podcast, Nickels and Dimes. So you can go back still and listen to those episodes if you want to. But the truth is, so many people don't even understand the benefits that are available to them. And they're not learning a financial education that would put them in the position to save like my parents did and be able to fill in those gaps in spite of not having life insurance. September is Life Insurance Awareness Month, and too many people are either underinsured or uninsured altogether. Nearly 4 in 10 households say they would face financial hardship within 6 months if the primary wage earner died, and 1 in 5 households would struggle within a month. That statistics comes from LIMRA. This week's money tip is in alignment with finances, which, yes, life insurance is the theme of today's episode. But in general, my money tip is to review your beneficiary designations annually, not just on your life insurance, everywhere you have beneficiaries. Many people forget to update after life changes like a marriage, a divorce, or having new children. Outdated beneficiaries can cause legal disputes or assets going to unintended individuals. So here's your practical takeaway. Take 10 minutes this week to check your 401k, your life insurance, and any annuities or financial products where you designate beneficiaries, and make sure the right people are listed. If you have a will or a trust, make sure that that's updated as well. Now let's get back to this week's episode and talking about all things life insurance. My goal today is to provide you with more information about the different types of life insurance and what they do to help you make a better decision on what kind of life insurance you should have, or whether or not you should sit down and look at upgrading the policy that you have. So we're going to start with number 1, term life insurance. Term life insurance covers you for a set period of time. So maybe 10, 20, 30 years. There can be different increments with different policies, but typically you're going to see a 10, 20, 30-year product. The pros of term life insurance is it's affordable, it's simple, easy to understand, and it's great for young families. When your budget might be smaller, but you have children and a spouse and maybe a mortgage, and so your need is bigger. Now, the cons to term life insurance is that you don't have the ability to build cash value in term life insurance products, and it expires eventually. When that 10, 20, or 30-year time frame is over, that policy goes away. I always tell people it's like comparing renting versus buying when you're talking about housing. If you buy a home, when your mortgage is done in 30 years, you have the home. It's now an asset. When you rent At the end of the term of your lease, that is gone. There's no asset there. That money is spent. The average monthly premium for a healthy 30-year-old for $500,000 on a 20-year term life policy is only about $20 to $25 a month. So y'all, for less than $1 a day, a 30-year-old could get themselves enough to possibly pay off a mortgage, replace a couple years of income for their spouse and their kids should something happen to them. So remember, term is like renting insurance. You only pay that for the years that you need the most protection. So when do I, as a financial professional, utilize term insurance with a client? Great question. I utilize term insurance in a couple of different scenarios. Number one, if a client really truly just wants term insurance, we're going to look at everything. I'm going to provide them the education. But at the end of the day, if I show them multiple options for life insurance and they select term, I'm going to give them term insurance. Mind you, the term insurance I work with includes living benefits, and I'll get to that a little bit more further down in the episode. But I'm going to give the client what they want. Once I've provided them the information, we've talked about their goals. Now, another time is for a young family, the example that this category already talked about. So let's say I'm meeting with a couple and they're both 30 years old. They've got 2 small children. They owe, say, $300,000 on their mortgage, and each one of them makes about $50,000 a year. Okay. Now, typically, if you wanted to provide for your loved ones, your family, for an extended period of time, the standard calculation on life insurance I do is 10 times your annual income. So if you make $50,000, I would recommend getting a $500,000 policy. That would replace your income for 10 years. Now, if your children are very small at that point, we're going to look at when will they be grown and out of the house. That's where a 20-year term in this example makes sense. In 20 years, your kids will be grown. They'll be out on their own. So put that $500,000 policy in place. That way, if something happens to you, your spouse could use it to maybe pay off the house or put in another investment that is providing some income that they can use to help pay the house payment. That money's growing and then can provide for college education if that's something you wanted to make sure your children had the opportunity to do, down payments on their houses, to pay for weddings, whatever it might be. But not only that, what if your spouse is a stay-at-home parent and needs to go back to school so that they can get a job that would provide for your family the way that you guys always wanted? Maybe get a promotion, start making more money. Or what if they wanted an opportunity to start their own business? Maybe what they do is a business and they want to grow that to provide for their family and make sure they don't have to work outside the home. Lots of different scenarios there. But that $500,000 then becomes available when you pass away for them to utilize for all of those different things, to fill in the gaps and even to maybe take a year off and spend time with the children, work through their grief, and figure out what their next best steps are. So that's term life insurance. Now we're going to jump over and we're going to talk about the second one, whole life insurance. Whole life insurance is permanent coverage with guaranteed cash value. The pros of whole life, it builds savings, it has fixed premiums, and there is a guaranteed death benefit. The cons are that it's more expensive than term. Now, let me give you an example of what whole life insurance can do. It can act as a forced savings account. So you put money in there every month paying for the premium. You've put a lump sum of money, or maybe you're paying more than the premium to build up cash within this policy. But that means you have cash available to utilize, and you have a life insurance that's going to ask for or exist for your whole life, hence the name whole life insurance. Now, with whole life insurance, unless you add a rider for there to come a point that you stop paying premiums, you will continue to pay premiums your entire life that you have this plan. But you can add riders that allow you to stop paying premiums at some point and the policy is paid in full. One of the other things about whole life insurance is that as that cash is building up, let's say you have $500,000 of insurance and you have $300,000 in the policy. When you pass away, you're going to get just the $500,000, right? So you're paying that cash in and it is part of the death benefit. It's not in addition to, unless again, you add a rider to your whole life insurance policy that adds that cash value building in the policy on top of the death benefit. So maybe you say, well, then why would I put money in it? Well, because that money is available for you to utilize along the way and you'd still have your death benefit. Okay. So definitely you want to work with somebody that understands whatever kinds of plans you're looking at or can explain all of the options to you that fit your goals and your needs to make sure that you get the right thing put in place. And most importantly, that you really understand exactly how it works. All right. Now, I often would use a whole life insurance for somebody that has a big lump sum of money that they want to put in a life insurance policy right away. Maybe even business owners who have a more significant amount of money to put away, and they want to be able to access that money as time goes on. Okay. So that's really where I would be using whole life insurance. So now we're going to get to the third type of life insurance, which is universal life. It can be called index universal life. So this is a life insurance that has flexible premiums and coverage. Cash value can grow within this policy based on interest rates or market indexes. Sometimes those indexes will have caps and floors, but not always. I work with quite a few that don't, and I like those ones because it means you can earn as much as there's available for you to earn. These products are great for people who want lifetime protection plus a way to accumulate wealth, tax advantaged. So this would be a situation, for example, where a client doesn't have a lump sum, a big lump sum right now that they can throw into a whole life. They need to build that over time. So they get this index universal life policy. There is the cost of insurance, but then on top of that, they're funding this policy in a way that it builds cash value over time. Now, here's the cool thing. As I mentioned just a moment ago, it gives you the ability to accumulate wealth tax advantaged. And this is not a rider that gets added to the plan. This is how these plans are designed. That money is growing tax advantaged. But in addition to that, you have access to that money along the way. There's no 59.5 rule here that you can't access your money without taxes and penalty. There are no taxes. There are no penalties. So this is a great place to extend or even add to increase your emergency fund. I have a lot of clients that they have a savings account. It's their emergency fund. Maybe it's $10,000 or $15,000, but they see the value of putting it in a product like this that could potentially earn somewhere between 8 and 11% over time versus just leaving that $10,000 or $15,000 in a bank account that the interest doesn't even outpace inflation. But it's also a place that you can build retirement savings. For investors, a lot of times they'll use it and build up that cash value and then borrow that money from themselves in this policy to add to their real estate portfolio. A lot of different things you can do with this plan. Now, IULs are like having protection and an investment vehicle in one. What does that mean? It means index universal life policies have no market downside risk. You cannot lose your money. Your principal, as you put it in there, is protected from losses. And as you earn interest and it's applied to your account, that is also protected. So that is the guarantee of that market downside risk that's available in this kind of product. The other thing about Index Universal Life, the providers I use, the products that I put in front of my clients also include living benefits. So you're getting a death benefit in case you pass away, living benefits to protect your health along the way, and the ability to build retirement savings, investment, whatever you're looking to do from a cash value perspective. Now I'm going to shift now more into living benefits and what they are, because a lot of people are, not totally familiar with what these are and how they work. So living benefits are things like critical illness coverage, chronic illness coverage, terminal illness coverage, critical injury coverage. Even I have one company I work with that has an Alzheimer specific memory care piece to their living benefits. So the combination of those is different by carrier and product. Most of them, at least I will say all the ones I work with, but most out there are going to include critical illness, chronic illness, and terminal illness. And then they may have that critical injury, Alzheimer's, some of those one-off things in addition to. Now, these are considered riders, but in the policies I work with, they're included in your cost of insurance. They are built into that product. So when I give a client a quote, that premium I'm quoting them includes those living benefits. They're not going to be in addition to that initial quote I give them. So living benefits give you access to part of your death benefit while you're still alive. If you're diagnosed with cancer, if you have a stroke, a heart attack, you need long-term care at some point. It gives you the ability to tap into that death benefit while you're still living to cover lost wages, to cover monthly bills, to cover medications, treatments, whatever that might be. You have access to those funds. And the way you have access and the amount you have access to is a little bit different for each one of them. Critical illness, chronic illness, terminal illness. Some will be lump sum amounts calculated in a certain way. Chronic illness is typically a monthly payout that comes on an ongoing basis. And so whatever plan you're working with, you can see the details of those. I don't go into them here because they could be different with each policy. But when I show that policy to a client, I'm talking about here's what it covers from a death perspective. Here's what it covers from a living benefit perspective. Here are the amounts that would be available at different ages. And here's what it covers or provides from a cash value perspective based on the budget they gave me to build the product. Okay. If you have more questions about anything I'm going over today, any of these products, but specifically living benefits, again, a lot of people aren't super familiar with them, don't understand exactly how they work. Please reach out to me. You can go to the show notes. There's a contact the show link. You can send me a message directly, but please reach out and ask questions. I want to make sure that people get the information that they're looking for, that they need, that they want to make good financial decisions and make sure they have the life insurance that best fits themselves, their families, and their goals. Okay. What's the impact of living benefits? Well, in all honesty, it helps families avoid financial ruin during a medical crisis. Think about this. And I had this conversation with a potential client the other day. If you have $500,000 going into retirement and wherever you have it at, right? That's your retirement money. You put it in something and it's giving you monthly income, maybe in addition to your Social Security, whatever else you have, but you have $500,000. And 5 years later, you get diagnosed with cancer or you suffer a stroke. The cost of that care, and especially if you need long-term care, the average cost of a private room in a long-term care facility is between $60,000 and $80,000 a year. How quickly would that $500,000 be gone? Diagnosed with cancer, you need surgery. And yes, in retirement, you've got Medicare or whatever retirement health benefits, maybe you still got from your employer or as part of your pension, whatever that is. there's still going to be those out-of-pocket costs. So here you have the ability to tap into that death benefit, access those living benefits, and use that while you're still living to cover your cost of care. And therefore, it doesn't bankrupt your retirement, which you need to continue living. Because if it's all one and the same, what happens when that's gone because of a medical emergency? What happens to the legacy that you wanted to be able to leave behind? 60% of bankruptcies in the US are tied to medical expenses, y'all. These benefits are a game changer when it comes to those kind of situations. When I think about my parents being in this caregiving role, that thought process about living benefits or making sure, because my parents couldn't get them, was so important on where we put their money to grow it, protect it until we need it, to make sure that basically we're creating a situation where my parents are self-insured because they can't get the insurance any other way. And then they had other money that we put in places that's going to continue to provide an income for them in retirement, even though their needs are smaller because they live with me. So with all of those things in place, my parents are going to be okay, but it could have been very different. My dad never thought they'd be able to leave a legacy behind. And after we moved their money to all of the places, I actually showed him with the way that we set things up that they're going to be able to cover any cost or any needs they may have medically. They're going to be able to have additional income if necessary along the way. Right now, their retirements and Social Security more than cover their needs. And because of that, if they don't ever have to access additional income, they're going to be able to leave a legacy behind. And my dad got really emotional when I told him that, again, because he just never thought they were in a position that they were going to leave a financial legacy behind. And my brother and I don't care about getting our parents' money, but my dad cared about leaving something behind. And it feels good for me with what I do to be able to have given him that realization and that opportunity that he's going to be able to do that. So there's so many things that living benefits can help to protect. It helps to protect your health overall, your family's financial situation, your future ability to retire or live the way you want and retire, and the ability to get that long-term care that can be very expensive, but vitally necessary for so many people as they age. Now, the last category I want to talk about today is final expense insurance. So what is final expense insurance? It is what it sounds like. It is for final expenses when somebody passes away. Now, we see lots of GoFundMes out there for sure. And I understand that sometimes they're unfortunately necessary. But GoFundMes are a huge part of the reason I talk about life insurance like I do. But having a life insurance policy does not guarantee a family won't need a GoFundMe, because you see life insurance policies on average are going to take around probably at least 30, maybe 60 days to pay out. There's a process, there's paperwork, all of those things. Well, most people typically have a funeral and bury a loved one within a week or so after their passing. So where do they get the money to do that? Well, hopefully people have that's what emergency fund is for, the loss of a loved one, a major issue with a house or an appliance or an expense that comes up that was unexpected, right? That's what you would use that money for. But not everybody's in the position to have that kind of a savings sitting aside. As a matter of fact, most people are not. Most people could not cover a $400 emergency today if one arose. So how in the world are they going to pay those final expenses? They start a GoFundMe. So final expense can be the answer to that. This is a smaller permanent policy, usually $5,000 to $25,000 total, that is meant to cover the costs of a funeral and burial or cremation, whatever your desires are or the person's desires are. The average funeral cost today is somewhere between $8,000 and $12,000, according to National the National Funeral Directors Association. That one tripped me up. So that's what that money is for. Final expense insurance, you have the ability to make a phone call, let them know your loved one died. It is significantly less paperwork and things. That money gets transferred to you, usually within 24 to 72 hours to cover those costs, avoiding the need for a GoFundMe and allowing you to not be stressed out while you're waiting for the life insurance benefits, those longer term life insurance, bigger policy amounts to pay out. I personally have a term insurance policy and I have a final expense policy. Between my son and I, we have 3 IULs. So that permanent with cash value building. I don't have any whole life insurance at this point, but I'm covered with the IUL policies. And then my term insurance is additional coverage that I got. My son was still at home. He was a senior in high school when I got that policy. And then pretty quickly after I became a caretaker for my parents. So that policy covers, if something happened to me, that money would go to my son, but he'd be able to step in and help make sure my parents are taken care of the way they need to be. He could keep them here in this house they came to live with me in, and then help them just have their daily needs covered. And my brother would take over my parents' estate alongside my dad or in place of my dad if he's gone, but my mom is still here. So that is where those beneficiaries become important. Having that trust becomes important. Making sure everybody knows what policies you have and how to access them and who to call if something happens. All of that is very, very important. That is a component I'll talk a lot more about in a future episode as well. But again, final expense insurance ensures your loved ones don't have to set up that GoFundMe just to bury you. Life insurance allows them to continue living the life that you dreamed about giving them when you're no longer here. So I want to encourage you guys this month, review your current policies. If you only have life insurance through your employer, we need to have a conversation. And I say that because at any moment, your employer could terminate your employment. You no longer have life insurance if that happens. You need an independent policy to ensure your family's taken care of. Your employer's policy should be the icing on the cake or the sprinkles on the cake, but your personal policy is the cake itself. Okay? So I want you guys to review the current policies you have. Make sure they include all of the things you want them to have based on this episode today, the things that I shared with you. If not, again, reach out to whoever you're working with on your finances. Reach out to me. I'm happy to audit policies with you, make sure you have the right things, and show you additional options that are available. Excuse me. So I am always a resource if you need me. But review those policies. Make sure they're up to date. If you only have a term policy, make sure you know when that term is going to run out. Make sure you have a conversation about, do you need something else? Do you want something permanent? Maybe you got a term insurance policy when you were young and single, but now you're married, have a mortgage and children, right? So make sure you look at what you have so you can have the right conversations to get those updated, to get some additional policies put in place, whatever your needs might be. Make sure that you review your beneficiaries from my hot tip or my money tip, today. Make sure you're working with a licensed agent to help you make these decisions. There's reasons that we're licensed because we have all the information to give you. Don't just listen to a neighbor or a family member that tells you you don't need it, it's too expensive, or they had a horrible experience with it. Life insurance today is not the life insurance from 30, 40 years ago. If you want to know what it really is, what it really looks like, and what it really can provide, you need to work with somebody that's licensed for those products that can fully explain it to you. All right. The third thing that I want you guys to take action on this month is don't wait. Coverage costs more every single day you wait to get it. So in your 20s and 30s, you think I'm young, I have so many years ahead of me. None of us are promised tomorrow. Absolutely none of us are promised tomorrow. So your waiting till tomorrow or next week could cost your family everything. And no matter how old you are, today's the best day to start. You'll likely be surprised at how affordable life insurance benefits can actually be. Okay, as we wind down this episode, you know what it's time for. Nat's hot take. Here's my hot take. It is confession time, y'all. I am unapologetically Team Pumpkin Spice. Call me basic. I don't really care. I love it. Pumpkin spice lattes, candles. I literally just ordered 3 fall candles the other day. 2 of the 3 have pumpkin spice scent in them. The muffins, what else did I get? I don't know if you guys don't have Andy's frozen custard where you live. I feel really bad for you. But they actually do a pumpkin pie one where they blend a piece of pumpkin pie. I know it's not the most healthy thing, and I don't have them all the time. But they blend a piece of pumpkin pie into vanilla custard. It is amazing. Pumpkin pie, pumpkin spice, pumpkin, everything is my jam. But here's the hot take. It shouldn't just be for fall. Why are we limiting pumpkin spice to only a few months out of the year? If I can have iced coffee in January, why can't I have pumpkin spice in April? I know. There's the pumpkin spice haters out there. You're cringing at this entire segment of the episode. But you know what? If it's not pumpkin spice for you, it's something. There's something that comes out at a certain time of the year and you're like, why can't I have this year round? So I know you feel me from that perspective, whatever that is for you. But at the end of the day, I feel like we just need a full year-round option. Here's the money lesson in this hot take. Just like pumpkin spice shouldn't be seasonal, protecting your family with life insurance shouldn't just be a once-a-year conversation in September. It should be part of your life year-round. I want to thank you guys for joining me this week on Chat with Nat. I hope that the information I shared with you today about life insurance was beneficial to you, was educational to you. And you know what? If you're set and you didn't need this information, please share this episode with friends, family members, children you have who are not covered with life insurance or who you aren't sure if they are covered so that they can get the information and make sure that they are. I would appreciate it if you would share this podcast out to the podcast lovers in your life. Please go give me a rating wherever you're listening to this on. Those ratings help boost my podcast so it gets in front of more people. And the information that I share, the information my guests share every single week, these conversations that you get to listen to, get into the ears of who needs to hear the message. So thank you for joining me this week on Chat with Nat. I can't wait to be with you again next week. And until then, take care and stay safe.